Welcome back to Curious Commerce. Let us continue the topic sources of finance. Welcome back to part 3. Let us discuss about the distinction between equity shares and preference shares. Equity shareholders are real owners of the company. Preference shareholders are not real owners. Related to the dividend rate or dividend declaration, for the equity shareholders, it is not constant or it is not fixed in nature, it is fluctuating from one year to another year. But for preferential shareholders, the dividend is fixed for the end duration. Related to the repayment, for the equity shareholders, there is the last priority. But for the preferential shareholders, generally it is priority over equity. The risk level is highest in equity but relatively lower compared with the equities. The risk level is less in preference shares. Related to the market value, always the value of the equity shares is fluctuating on the base of the market condition. Related to the preference shares does not fluctuate, it will be constant. Related to the equity shares, redeemable and convertible nature is not exist, but for the preference shareholders it is possible to redeem after the end duration and it is possible to convert to the general equity shares also. Related to the arrears of dividend, so cannot accumulate, but in the case of the preferential shares, it is accumulated. So these are all the general differences between the equity shares and preference shares. The next sources of finance is retained earnings. Retained earnings refers to the portion of profit retained in the business. It is not distributed as dividend to shareholders. Retained earnings are reinvested in the business. They are used for expansion, modernization, or replacement of the existing machineries or the technologies. This is an internal source of finance that does not involve any issue cost. For understanding purpose, for an example, a company earned 10 crore rupees. It distributes 6 crores as dividend. The remaining 4 crores is retained earnings. The merits and demerits of retained earnings. Retained earnings are the cheapest source of finance. That is the merit. There is no legal obligation to repay. It does not dilute ownership or control. It improves financial stability. However, so certain the demerits of the retained earnings are excessive retention may dissatisfy shareholders. It leads to agency problem. It may reduce market value of shares. When the market value of shares decrease, automatically wealth of the organization is also decreased. There is also a risk of inefficient use of retained funds. Management may misuse excess funds. The next, the long term source of finance from the debentures or the borrowed capital. Debentures are written acknowledgement of debt issued by a company. Debentures are written acknowledgements of debt issued by a company. They indicate that the company has borrowed money from the public. Debenture holders are creditors of the company. They do not have ownership rights. Interest on debentures is fixed in nature. Interest must be paid regularly. It must be paid even if the company incurs loss. It means that it is an obligation for the company in every year. Debentures are generally secured by asset of the company. They are suitable for companies with stable and regular income. Related to the debentures, the major types of the debentures are naked or unsecured debentures. Debentures are issued without the security called as in the unsecured or the naked debentures. Secured debentures are supported by security or asset. So that debentures called as in the secured debentures. First mortgage debentures have first charge on assets. Second mortgage debentures have second charge. Redeemable debentures are repaid after a fixed period. Irredeemable debentures are repaid only at liquidation. Registered debentures are transferable through proper registration. Bearer debentures are transferable by mere delivery. Convertible debentures can be converted into shares after the end duration. Non-convertible debentures cannot be converted. The major merits and demerits of debentures as follows. Debentures are a low cost source of finance. That is the major merit of the debenture. Interest on debentures is tax deductible. They do not dilute control of shareholders. They provide advantage of trading on equity. However, the certain demerits of the debentures are debentures create fixed financial burden for the organization. Interest must be paid irrespective of profit or loss. Failure to pay interest may lead to insolvency. Security requirement reduces asset flexibility. The distinctions between the shares and the debentures. Shares are owners of the company. Debenture holders are creditors of the company. Dividend on shares depend on profit. Interest on debentures is compulsory. It is fixed in nature. Shares involve higher risk, debenture involve lower risk. Shares do not require security, debentures are usually secured. Long term loans from financial institutions. Financial institutions provide long term loans to businesses. They support industrial and economic development. Examples include IFCI, IDBI, SIDBI, and other state financial corporations. Loans are provided for setting up new units. They are also provided for expansion and modernization. These loans are given after detailed project appraisal. Institutions may impose certain restrictive conditions. However, they also provide technical and managerial guidance. The merits and demerits of long term loans from financial institutions. Merits of long term loan from financial institutions. Long term loans from financial institutions are available at a reasonable cost. That is the merit. The rate of interest is generally lower than other sources. These loans provide advantage of trading on equity. They help in financing large projects. However, these loans increase financial risk of the organization. Interest and principal repayment are compulsory. Security is required for obtaining these loans. Financial institutions may interfere in management decisions. They also impose restrictive clauses. The loan sanction process is usually lengthy. The next source of finance is loan from commercial banks. Commercial banks are an important source of business finance. Traditionally, banks provided only short term loans, but in modern banking, banks also provide term loans. The term loans are provided for 3 to 7 years in generally. These term loans are used to purchase machinery and equipments. Bank requires collateral securities before sanctioning the loan. Banks examine the creditworthiness of the borrower. They also examine repayment capacity. It means that they identify the what is the worthiness of the organization and what is the willingness of the organization. In the loans from commercial bank, The one platform is there, that platform called as in the bridge finance. Bridge finance is a short-term temporary loan given to the artificial person or the business. It is used until permanent finance is arranged. Bridge finance helps during project implementation stage. It fills the gap between short-term need and long-term finance. The cost of bridge finance is generally high, but it fulfills the needs. It is used only for the shorter duration. Thank you all for daily updates. Follow the WhatsApp channel Curious Commerce Financial Management Hub. Please share and subscribe. The topic sources of finance will be continued in part 4. Thank you all.